In macroeconomics, the value of a country's currency relative to others is a critical factor influencing international trade, capital flows, and overall economic health. Changes in currency values can occur naturally due to market forces or be engineered by governments. Let's delve into the professional and intuitive core of these terms. 1. Currency appreciation. Professional definition. Currency appreciation refers to an increase in the value of a country's currency relative to other currencies in a floating exchange rate system. This means that a unit of the domestic currency can now buy more units of foreign currency. Intuitive core. Imagine your local currency, say the Indian rupee, INR, gets stronger. If one United States dollar was equal to 80 Indian rupees, and now it's one United States dollar equals 75 Indian rupees, the rupee has appreciated. This means you need fewer rupees to buy one US dollar. Your rupee has more purchasing power internationally. Why it happens? Market forces. Strong economic performance. A country with robust economic growth, low unemployment, and a stable political environment attracts foreign investment. To invest in that country, foreigners need to buy its currency, increasing demand and pushing up its value. Higher interest rates. If a country's central bank raises interest rates, it makes saving or investing in that country more attractive for foreign investors seeking higher returns. This hot money inflow increases demand for the domestic currency. Trade surplus. When a country exports more goods and services than it imports, it earns more foreign currency. This foreign currency is then converted back into the domestic currency, increasing its demand. Low inflation. If a country has consistently lower inflation than its trading partners, its goods and services become relatively cheaper over time, increasing their demand and, consequently, the demand for its currency. Political stability. A stable political environment reduces risk for investors, making the country's assets and currency more appealing. Impact. Imports become cheaper, good for consumers and businesses relying on imported raw materials. Exports become more expensive, can hurt export-oriented industries and reduce trade competitiveness. Can lead to a trade deficit, as imports rise and exports fall. Potentially lower inflation. Due to cheaper imports, makes foreign travel cheaper for domestic citizens. Can deter foreign direct investment, FDI, seeking lower costs. 2. Currency depreciation. Professional definition. Currency depreciation is a decrease in the value of a country's currency relative to other currencies in a floating exchange rate system. A unit of the domestic currency now buys fewer units of foreign currency. Intuitive core. This is the opposite of appreciation. If the Indian rupee weakens from 1 United States dollar equals 80 Indian rupees to 1 United States dollar equals 85 Indian rupees, the rupee has depreciated. You now need more rupees to buy 1 US dollar, meaning your rupee has less international purchasing power. Why it happens? Market forces. Weak economic performance. A struggling economy, high unemployment or political instability deters foreign investment, leading to a decrease in demand for the domestic currency. Lower interest rates. If a country's central bank lowers interest rates, it makes saving or investing in that country less attractive, leading to hot money outflows and reduced demand for the currency. Trade deficit. When a country imports more than it exports, it needs to pay for these imports in foreign currency. This increases the supply of the domestic currency in exchange for foreign currency, driving down its value. High inflation. If a country experiences higher inflation than its trading partners, its goods and services become relatively more expensive, reducing their demand and, consequently, the demand for its currency. Political instability, uncertainty. Political turmoil or uncertainty can lead to capital flight, where investors move their money to safer havens, reducing demand for the domestic currency. Impact. Imports become more expensive, can lead to imported inflation as the cost of foreign goods rises. Exports become cheaper, boosts export competitiveness, potentially leading to higher export volumes and job creation in export sectors. Can lead to a trade surplus, as exports rise and imports fall. Makes foreign travel more expensive for domestic citizens. Can attract foreign direct investment, FDI, seeking lower production costs. 3. Currency devaluation. Professional definition. Currency devaluation is a deliberate downward adjustment of a country's official exchange rate relative to a foreign currency or a chosen baseline, like gold. This occurs in a fixed or managed exchange rate system, where the government or central bank actively sets or influences the exchange rate. Intuitive core. Think of it as a government explicitly deciding to make its currency cheaper on the international market. For example, if a government announces that instead of $1 equals 80 Indian rupees, it will now enforce an exchange rate of $1 equals 90 Indian rupees. This is not due to natural market supply and demand but a policy decision. Why it happens? Policy decision. To boost exports. The primary reason for devaluation is to make a country's exports more competitive in international markets. Cheaper exports can stimulate economic growth and reduce a trade deficit. To reduce trade deficits. By making imports more expensive and exports cheaper, devaluation aims to improve a country's balance of trade. To reduce foreign debt burden, in local currency terms. If a country has significant foreign currency denominated debt, devaluing its currency can make it seem like the debt is smaller when converted to the local currency, though the actual foreign currency obligation remains the same. To attract foreign investment. A cheaper currency can make domestic assets, stocks, real estate, businesses, more attractive to foreign investors. Impact. Similar to depreciation's effects on trade. Exports become cheaper, imports become more expensive. Risk of imported inflation. As the cost of imported goods rises, can hurt domestic purchasing power, making foreign goods and services unaffordable. Potential for currency wars. If other countries respond with their own devaluations to maintain competitiveness, can lead to a loss of international confidence, if done too frequently or without clear economic justification. 4. Currency revaluation. Professional definition. Currency revaluation is a deliberate upward adjustment of a country's official exchange rate relative to a foreign currency or a chosen baseline. This also occurs in a fixed or managed exchange rate system. Intuitive core. This is the opposite of devaluation. It's a government decision to make its currency more expensive or stronger against other currencies. For instance, if a government changes the official rate from $1 equals 80 Indian rupees to $1 equals 70 Indian rupees. Why it happens? Policy decision. To combat inflation, by making imports cheaper, revaluation can help reduce domestic inflationary pressures. To reduce a trade surplus. If a country has a persistent and large trade surplus, revaluation can make its exports more expensive, thus reducing the surplus and addressing trade imbalances with other nations. To increase purchasing power, a stronger currency allows domestic consumers and businesses to buy foreign goods and services more cheaply. To signal economic strength/stability, a government might revalue its currency to signal confidence in its economy and attract foreign investment. Impact. Similar to appreciation's effects on trade, imports become cheaper, exports become more expensive, can reduce inflation due to cheaper imports, can lead to a trade deficit, as imports rise and exports fall, can face political pressure from domestic exporters who lose competitiveness. In summary, currency appreciation and depreciation are market-driven movements in exchange rates in a floating system, while devaluation and revaluation are deliberate policy decisions by governments or central banks in a fixed or managed system. Understanding these distinctions is fundamental to analyzing international trade, investment flows, and macroeconomic policy.